Put the spotlight on the banking space. And one of the best analysts on the street, who's a lot of top fund managers listen to very closely, is Ashish Gupta. He's also the head of research at Credit Suisse and particularly looks at financials. Ashish, thank you very much for chatting with me today on the show. Now, the banking sector or financials in particular have been on the receiving end of the slowdown or, a shadow recession which we are staring at in the economy. And the fear is, that there could be a new slew of NPA which are coming. There is also talk of possible forbearance for the sector. How are you analyzing the risks that this particular sector face right now because of the coronavirus-led slowdown? And then we'll come to the various parts of financials.
Okay, sure. Thank you for having me on the show. So I guess the immediate challenge for most banks has been just to keep their network operational despite the restrictions on account of the lockdown movement of staff. But from what we see, most managements have been able to achieve this adequately, and I'm sure given all the business continuity planning, they will be able to manage those. But as you rightly mentioned, there are several risks that are emerging both on the asset and I will add on the liability side as well that every financial institution will need to manage, right? And on the asset side, if we look at risk, we have to look at risk in two sorts of buckets. One is the near-term risk. And in the near term, again, as of now, it's a 20-day lockdown. Hopefully, it doesn't get extended too much beyond it. But given that in the near term, collections, particularly those that happen on a cash or physical basis, will become a challenge. The good news is that for most lenders, not just banks, even NBFCs, 90 to 95% of collections happen through electronic NSCH means, etc. But the fact is that depending on the segment, several people do miss payments, and chasing them to regularize accounts in this environment will be more difficult. Also, several businesses as well as individual cash flows will be disrupted in this time. So how do collections pan out will definitely be a risk here to watch out. But as you mentioned, some of this can be sandpapered by the forbearances that can kick in. And I'm sure the regulator is looking at it as we speak. I think the bigger question is on the medium-term risks on the asset side, because I think several business models may be permanently impacted by this industry, like travel, tourism, commodities. Let's not forget that oil prices are at historic lows, right? And we will also see that even when we get on the other side of this disruption, several businesses which are more informal in nature or self-employed consumers may find it more challenging to get back to the same set of cash flow generation as they were in the past. And the third issue will be that there are both enterprises as well as consumers who are probably a bit over-leveraged or are thinly capitalized. So even a temporary dislocation in cash flow can mean permanent damage, right? So those are two broad categories of the asset side risk that we need to focus on. I think equally important and probably a bigger focus right now is the liability side risk, because both on account of the COVID situation as well as the global credit market freeze, the domestic credit markets have also got frozen, right? And you would have seen not just that the bond yield have, even on the government securities, have moved up, but even volumes of transaction there have come down. and that's happening on the G-Sec side. The situation on corporate bonds is even worse. And really, except for really blue chip AAA names, no one has been able to access the wholesale credit markets in the last few days. So that is, I think, a bigger challenge. How do we get the credit market functioning? How do people who borrow wholesale continue to get money? And in fact, we have seen after the delayed Yes Bank bailout, some of the small and mid-sized private banks seeing both some degree of credit outflow and, at least in the secondary market, the yields on their paper go up.
Ashish, which end of the lenders are at relative more risk or higher risk than the others? We spoke to a host of lenders in the last couple of days. Large banks say that we are adequately capitalized and our recoveries will be in time. Certain NBFCs we speak to are raising a possibility that certain set of borrowers may delay payments, and hence they are looking for regulator help on that. In your view, which section of the entire lending chain is at higher risk than others?
Sure. So I think on the again, I'll kind of answer the question in two ways. We look at lenders both based on the liability side as well as asset side differentiation. So people who are wholesale funded, I think will definitely be more challenged given the credit market phase that we spoke about. On the asset side, I think really people who have more cash collections will get impacted. People who have relatively higher exposure to SMEs or are in segments, consumer loan segments where self-employed consumers are the larger share of borrowers, these will be more impacted.
What would you like to see from the policymakers? What kind of intervention over and above what has happened? Yes, there have been a lot of liquidity injection and steps taken. Would rate cuts also suffice? What other measures would you like to see, which if regulator takes shortly, can cushion the blow on the banking system or the lending or the credit market overall?
So I will say that rate cuts will certainly help, but in this kind of disruption, I don't think they will suffice. Right? And even in terms of the liquidity injection that is happening today, it is primarily happening against collateral of treasury securities, against government bonds. Right? And I think that probably will not be adequate given the complete freeze in the credit market. In fact, some mutual funds have been trying to sell even bank paper, and they are struggling to do that. So I think the regulators in India, like their counterparts in many parts of the world, have to start thinking about providing liquidity through means other than just collateral of government bonds. Right? So that is one set of measures that, of course, you need to have interest rate cut, but you need to bring down credit spreads as well, because even for AAA rated borrowers, credit spreads have shot up by almost 100 basis points in the last 2 to 3 weeks. In addition to that, I think one thing that will certainly be needed is some sort of forbearance or on NPA classification or relaxed timeline of payment, or even another restructuring window. But of course, we need to be mindful that this should not be done in a manner which is mandatory, because particularly for lenders who have committed liabilities, if the asset side duration increases without a change in their liability side duration, their ALM mismatch can be a bigger problem. So it should be optional, but I think probably some sort of restructuring window or forbearance should also help.
Last question to you. We've discussed and analyzed the environment and the situation as it stands right now. But at the same time, not to take away the fact that because of the sharp and swift correction, bulk of the bad news is also in the price. And probably that's why we are witnessing eagerness to get into some of these names at sharp cuts. In your view, on the valuation metrics, which space is looking relatively better off on the risk-reward point of view, which is already factoring a lot of bad news? Which are attractive areas?
Yeah, so I think you're right. Valuations across the board have taken very sharp cuts, and in fact, in most places, even those where we have been cautious, the cuts are much deeper than even what we anticipated. But given the amount of uncertainty that is around there, we would still be more comfortable going for businesses where we know the long-term outlook is great, right? So we know that irrespective of how long the dislocation stays, when we get on the other side of this dislocation, if anything, these lenders or these businesses will be even better positioned competitively, right? So, for example, the larger private banks, we believe, will be able to even consolidate their market share more, given that more NBFCs and smaller private banks will pull back in this environment. So I think if one goes with that medium-term outlook, rather than necessarily just looking for which is the cheapest stock to buy, that may offer a better risk reward.
Ashish, we'll let you go on that one. Thanks so much for chatting with us